Hello, welcome to another talk on money, business, and investing. My name is Jose. I'm the founder of the company and brand here at Master Investor. Ensure to subscribe, turn on the notifications so that we know when we go live or upload a valuable talk on money, business, and investing that can literally change our finances forever. As long as we apply the information that we're learning to be able to improve our wealth. Today, we're going to be speaking about how to do risk management. Is a topic that I love because a lot of people are afraid of investing due to the lack of financial education they have, and because of that main reason of their lack of financial education, it rises their level of fear of investing because they just don't know what they're doing, and therefore the risk becomes some sort of intimidating for them. The more we know about money, business, and investing, the better we are at reducing and managing risk. It's all about calculating risk. Our mission here at Master Investor is to elevate the financial well-being of humanity through high-quality financial education made simple with lucrative opportunities to build passive income and true wealth. Ensure to click the links in the description of this talk, as we have products, digital courses, we have 3 ebooks to help us understand more about how to build wealth successfully like the ultra wealthy do. It's all about obtaining and operating with the wealthy context. 2 types of mindset when it comes to money, as we have learned here at Master Investor. Poor mindset, or the poor context, and the wealthy context, the wealthy mindset. The poor and middle class are in the poor context. They operate with a poor context. They work for money. They don't know much about investing. They lack financial education. They listen to other people's opinions to invest, and they lack control. Find out what is risk management and how to apply it in our investments. Summary: investment risk and financial intelligence are correlated. The chance of becoming a successful investor is minimized when we are risk averse. Rather than being conservative, put these strategies for managing investment risks into practice. At the end of today's talk, we will cover a bonus question: what is the secret to getting wealthy? The real meaning of pay ourselves first, and the reason why the wealthy don't save money like the poor do. Remember, we want to be actively investing. The highest level of an investor is a capitalist investor. And that means that we understand debt. We understand what is money today, which is created with debt. We understand that money is debt, and debt is money, and we treat debt like we treat money or cash. And we put that to work into assets that are sound, assets that are producing positive cash flow because it's solving a problem successfully in the world. Every business and investment is built to solve a problem. A good question to ask ourselves is, what type of problem or problems do we want to solve in the world? And start from there. Reverse engineer our ideal scene. What is that we want to do as a legacy? What is the type of work that we want to give to the world? And every business is built for the people, for the niche, for those who are in need of the solution of what we have to offer as a company and brand. And we want to add intrinsic value when we are building a business from scratch. In business integrity, that's how we turn a company into a brand. Business integrity means that it's profitable, is lucrative, is making a profit because we are solving a problem successfully with systems. A true business is a system of systems, so it has to run on itself. We have to master how to put the systems together, how to get the people together, so that we can minimize risk, we can control risk. It's not about avoiding risk, it's about calculating the risk. It's about knowing everything about the investments that we are doing so that we can make the best decisions when it comes to a certain investment. Investors frequently ask themselves, How much risk am I willing to take? When discussing our investments with financial planners or stock brokers, they will always ask about our risk tolerance, which refers to whether we are conservative or aggressive. They don't even recognize, sadly, that that is the improper question to ask. Financial intelligence is related to risk management. Risk is not knowing what we are doing. Once more, the emphasis is on us rather than the investment. So it's not that investing is risky, it's the investor behind the investment that makes the investment or that makes investing risky. So we need to ask ourselves, who are we doing business with? Because it matters. People are going to be looking at our team, investors, banks, whoever is giving us money, because we're going to raise capital. As we know here at Master Investor, the highest level of an investor is a capitalist investor, like I mentioned early on. And that means that we are raising capital, we're using other people's money, OPM, OPT, other people's time, to make extraordinary investments that brings us 30% and above in returns on investment. And often it gives us infinite return on investment, or also known as IROI, infinite return on investment. And that is the holy grail of investing in business, ultimately, because that means that we're printing money from thin air. We're literally getting money from nothing, because we either recoup the initial capital that we invested back, or we're doing a 100% finance deal where we're not using any of our capital, and we continue to control the asset and collect the passive income from such asset. And the reason why we're able to raise the capital and invest without our own capital is because we have put the deal together. We put the opportunity for others to come and join. And remember, when we have something that is lucrative, money will find us. We don't even need to go crazy looking for the money, because there's always money looking for a new investment that is lucrative. So the job number one of an entrepreneur or a business owner is to raise capital. And the number one job of an inside investor is to master how to multiply money and sound investments and keep that money working hard. So rule number one in our community here at Master Investors is that we work to build passive income and multiply money through sound investing, because that's what the ultra wealthy do every single day. When discussing investments with financial planners or stock brokers, they are often focused on their interests, their commissions. They're not making money as an investor. So we need to be careful who we listen to. And that's why financial education is so important, because the more financial education we have, the more we will invest with facts, because we can read the numbers of an investment, we understand the investment, and we can make decisions based on what we know about the investment rather than making decisions based on what other people are telling us to do, which is a big difference. We got to take control of our financial decisions by simply investing more in our financial education. So figure out where we are financially today. We need to talk about money as much as possible. It's a topic that may throw people off at times, because people grow up with the wrong mindset, with the poor context, which tells them it's not okay or it's not appropriate to talk about money. And when we want to become ultra wealthy or financially free, we have to talk about money. We have to talk about businesses. We have to talk about solving problems. We have to talk about things that we may not like, but they are necessary in order to grow our wealth. And it's a beautiful and extraordinary feeling when we get to build a business from scratch. It's exciting and it's fulfilling in many ways. If we have an idea, launch into the market with a business plan. Remember, investing is having a plan. That's how we define investing here at Master Investor, is having a plan. If we don't have a plan, then it's not investing, it's gambling, and it's trading, and it's not really understanding what we are doing. We want to go into something knowing exactly how we're going to get out of that with an exit strategy that is on our favor. And we have everything planned out from A to Z. And yes, we will be flexible and we have to adapt to changes all the time. And more so in today's age with this fast paced technology that is growing tremendously with AI and other systems that are available to all of us to take advantage and help us do our business and deliver the solution that our businesses are producing to the world. Remember, every business and investment is created to build a solution or to provide a solution to the world. So what type of solutions do we want to provide to the world? What type of problems do we want to solve? A capitalist investor, the highest level of an investor, is always looking to solve a problem, a financial problem, usually created by uneducated business owners and inside investors. So we welcome problems and we find solutions that are lucrative and that are sane and based on the law and following the rules and regulations because we want to keep and protect our freedom. There's no point of becoming wealthy if we're jeopardizing the very reward that we're doing it for, which is total freedom. We don't jeopardize on freedom, our minds, and our time. We don't sell our time. That's why we don't work for earned income like majority of people do. We protect our time. We invest our time. We work to build passive income, which is a different type of income. It's not working for money. Passive income means that we're working to build assets and acquiring assets that are producing passive income or positive cash flow into our pocket, and sometimes capital gains income, because some assets will give us only capital gains income and some asset classes. However, our main focus is investing for passive income with control. We describe risk as investing blindly without understanding the distinction between uneducated and conservatives. When considering investment opportunities, many individuals may describe themselves as conservative. In practice, this term is frequently confused with uneducated. This means that the question financial planners should be asking is, are we educated or uneducated about our investments? Declaring oneself conservative is merely a risk management rationale that might readily be reinterpreted as I'm uneducated, afraid, unsure of what to do, and unwilling to put in the effort to learn, as majority of people run with this mindset. Consider this. Our financial planners will immediately realize we are uninformed about investments if we inform them that we are a conservative investor. That's why I always say improve our vocabulary when it comes to money. Learn new words every day. Part of the dictionary is dedicated to business. We need to master new words when it comes to the lingo of money, because the more words we have on our disposal and on our mind ready to be used, we can control rooms, we can control negotiations, we can see other investments that other people cannot see because we understand the lingo when it comes to money. So improving our business language is key when it comes to building wealth. Thousands of uninformed investors give their money to financial planners annually, and it is a dead giveaway that enables anyone with a questionable moral compass to prey on others' vulnerabilities and sell them whatever they choose. But who can say for sure that they are genuinely looking out for our best interest? Naturally, that is just something to think about if we are dealing with a real human financial planner. The total assets under robo management, which refers to a computer using automated algorithms to create and manage a client's investment portfolio rather than a live breeding person who considers themselves an expert in the field, increased 15% in 2018 to 257 billion with a B. By 2023, it was over 1 trillion. The financial advising industry is being transformed by technology at a rapid pace and not always for the better. Most financial planners adhere to the maxim: the higher the return, the higher the risk. However, that is not entirely accurate. The reality is that higher financial knowledge correlates with lower risk, whereas lower financial knowledge correlates with higher risk. And that is why enhancing our financial literacy is essential. It is the only method to generally learn how to minimize investment risk. Evaluating investment risk in another way. The investment risk dissuades many individuals who are preoccupied with the notion that safety and comfort are worth more than the benefits of investing, which is risky. They mistakenly believe that investing is dangerous when in fact the risk lies with the investor. Consider this: an investment is simply an investment regardless of whether it is a commodity, stock, share, a piece of real estate, cryptocurrency, or a company, or even a business. We, the inside investors, decide whether a particular investment is suitable for us or no. Let's start here. If we are curious about how to lower investment risk, the more knowledge we have, the higher our chances of lowering investment risk. We must calculate every return on investment with facts and not opinions. Additionally, we will be aware of the rationale behind our investments and the status of our funds if we have conducted our research or due diligence, which due diligence, as we know here in our community, are the second most important words in the business language. The first or the most important words in the business language are cash flow, and then due diligence are the second most important words. It's important that we understand how to do due diligence, because that's how it's going to help us understand whether something is an asset or liability. It's going to ultimately tell us this investment is for us, is not for us, is a bad investment, is something that we want to maybe improve. A lot of times we will find distressed investments that will require us to improve the infrastructure, and we know exactly what we're going to do before we even touch the investment. But we need to understand how to decode the real story of the investment, and it's done through reading the financial statement of the investment. In every investment, just like every person has a financial statement. That's why improving our personal financial statement is key to building true wealth, because as we learn how to read our personal financial statement, we are practicing how to read a business financial statement, because there's really no differences between the statements of a business and a person, except that one is a business and the other one is a person. But the fact remains that both have assets column, liabilities column, income column, expenses column, cash flow, debt, etc. So we need to master how to improve our personal financial statements. And if we never fill one out yet, make sure you go to our website, grab our ebooks, digital courses. We have tools, resources. We have a newsletter. If you like to get the articles that we're publishing every week via email, make sure you sign up for our newsletter and get our ebook and digital course, How to Build Cash Flow with the Internet Turn Passive Income On. Inside the digital course, we have added a financial statement. Actually, I think I have it pulled up right here, where it will help us understand where we are financially today. a majority of people have not done this. This is the first step if we're serious about becoming wealthy and financially free, is to fill out a personal financial statement. So go grab it on our website, sign up for our digital course, How to Build Cash Flow with the Internet. Find the link somewhere in the description. Inside the digital course, you'll find this blank financial statement that is ready to be used on Excel, and we can edit every single day as we grow our wealth, and everything will begin to change because now we're controlling the cash flow and we know exactly what we're going to do with the cash flow. How is the cash flow flowing inside our financial statement? And it's going to improve every single aspect about our finances when we do this exercise and we keep that as a habit in our daily lives. Very important, because every business will have a financial statement as well. So go grab How to Build Cash Flow with the Internet, Turn Passive Income on digital course on our website. Find the link in the description. And as we grow our courses, we will add more assets that will emphasize more on each topic of the volume of that asset, because each digital course that we have on our catalog is derived from a volume that we have created. So How to Build Cash Flow with the Internet, Turn Passive Income on digital course comes with the ebook, 49 chapters, 580 pages of financial education, step-by-step guide on how to build a successful business from scratch, how to launch it, how to do the due diligence, how to find a niche, and everything that we need to understand from A to Z is inside of that digital course. And also we have added a financial statement and a mutual agreement as of right now. As we're growing the catalog, we will add more assets in different digital courses that are already running and ready on our website. And as we add more assets, we're adding, for example, interviews with wealthy entrepreneurs, new entrepreneurs, inside investors, and people that are already having success in whatever they're doing. And we're going to come together on a podcast that is recorded professionally, and we're going to add that into that specific digital course to add more value, to emphasize more, to help our community become wiser and get golden nuggets from people that are already doing what we want to do. And so it's going to help us a lot. It's going to help the community become wealthier and wealthier as we move forward in this beautiful journey of entrepreneurship. So go grab our ebooks on our website, click the link somewhere in the description, and start investing in financial education, because it is the best education that we can have, financial education. Let's continue with investment risk and how to manage investment risk and how to avoid feeling afraid of investing due to the risk that it comes with. Because in business and investing, risk will always be found. It is all about the control that we have over that risk and the calculated risk that we're taking, because we have a business plan that is lucrative, that is a winning business plan that is based on facts, because we have read the financial statement, we understand everything about the business and investment. And that is the key of having success when it comes to business and building true wealth. We lose control and our risk factor increases considerably when we simply hand our money over to a financial planner to invest for us. Here's another way to consider this theory. Is a car driven by an experienced driver at 25 miles per hour dangerous? Likely not. A drunk driver operating the same vehicle at the same pace turns that vehicle into a weapon. The driver, not the vehicle, is to blame. It is the investor, not the investment, that is risky. The cash flow circle in investment risk. Some people think that intelligent people secures a good employment and save their money instead of making dangerous or risky investments. In contrast, an affluent person with the wealthy context believes that a poor person's context is dangerous. As business owner and inside investor, we want to start our own company and invest our money instead of putting it away in a bank or a fake asset like majority of people do, like 401ks, mutual funds, ETFs, and any other alike to those vehicles that are fake assets, because all they're doing is taking money away from the pocket of the investor and is not putting any money into their pocket. And as we know, a sound asset is a system of systems doing the selling and telling for us whenever we're not present. And it's creating positive cash flow into our pocket, even while we're sleeping, because it's a true business. It makes money without us being there because it has a system of systems. The way we tell whether something is an asset or liability is by the way the cash flow is flowing. Is it flowing into our pocket or is it flowing out of our pocket? Does it cost us money every single month or every single day to pay for such thing or to have such thing in our lives? And there's nothing wrong with having liabilities. In fact, we're going to expand more and more as we grow. It's not about shrinking. And when we feel like we are in danger in any situation, we want to expand. We don't want to go into a corner and become little. We want to have more communication, clean our communication lines, figure out what we need to do to market our products even better, to position ourselves so that we can reach more people and be able to deliver our product to the masses. Think of a product-based business, not just a service-based business. We want to build true brands. We want to build businesses that can help the world become a better place. And it takes time and it requires a lot of discipline. It's not easy. Otherwise, everybody will do it and everybody will become wealthy. But with the right steps, the right team behind it, with the right mentors, we can do phenomenal things and we can deliver solutions to the world and become wealthy at the same time legally. That's the most important thing, to be able to protect our freedom and everything that we're doing so that we can enjoy it. In fact, due to a lack of financial education in people's brain, majority uneducated people around the world today chooses to invest in one asset class, and they like to be told what to do when investing. We want to be the opposite of such type of mindset in individuals. We thrive to create freedom and keep it by expanding it, by following the law as we are becoming wealthy. We don't ever want to jeopardize on our freedom, mind, and time. The cash flow circle, which is composed of 4 types of people and 2 types of mindsets. When it comes to business and investing, the 4 people or the 4 types of people are the employee, self-employed on the left side of the cash flow circle, and the business owner and inside investor on the right side of the cash flow circle. See the diagram below to understand more about the cash flow circle, or CFC. It provides the best explanation for the different perspectives on the world. The 2 types of mindset are the poor context, which belongs to the ones of the left side of the cash flow circle, and the wealthy context belongs to the people on the right side of the cash flow circle. Most financial planners subscribe to the adage, the higher the return, the higher the risk. However, that is not entirely accurate. As we mentioned, the reality is that the greater our financial knowledge, the lower our risk. The lower our financial intelligence, the higher our risk. And that is why the only way to learn how to minimize investment risk is to enhance our financial intelligence through financial experience and meeting the 3 E's of a master investor. Number 1, financial education. Number 2, financial experience. Number 3, excess of cash flow. Once we accomplish those 3 E's and we have them and we can see them and they're tangible and we can touch those 3 E's, we're actively investing. That's financial experience. We're getting results. We're living from the passive income of our investments. We receive an excess of cash flow and we have financial education ongoingly in our lives. Then we are at the level of a capitalist investor. That's the highest level of an investor. That's a master investor. That's an inside investor. And that's ultimately what we want to be. On the right side of the cash flow circle, we will find the people that have freedom and true wealth. And people that change the world literally are found on the right side of the cash flow circle. As we can see, we pay the less in taxes. A business owner, usually we end up paying 20% and less because we have business expenses that are deductible legally through the tax code, because we're doing exactly what the government wants us to do. And when we do that, the government becomes our partner, because we live in a capitalist country with the capitalist system that is built to minimize taxes all the way to zero legally for the business owner and inside investor, where the rules of money were created by the wealthy for the wealthy, the ones that have the wealthy context and operate with that mindset. And the rules of money are available for everybody. We must understand that financial education was taken out of the school systems back in 1903, 1902, when the Rockefeller family hijacked, for lack of a better word, the school board and instilled a mission. And the school board saying that 2 types of people must come out of the school system from the time a person goes to kindergarten to the graduation of their university. 2 types of people. Number 1, employees that works for the corporation of the wealthy, and soldiers that defend the corporations of the wealthy, the governments. And that's why majority of people come out of a good school looking for a high-paying job, good benefits, good retirement plan. And that's how they feel secure, because they put security as a priority rather than investing as priority and becoming wealthy as priority. Their main focus is to feel secure and comfortable, and then they think about becoming wealthy. And we, as an inside investors, we have to put becoming wealthy as priority, and then comfortable and then secure last. Because once we achieve financial freedom and we control excess of cash flow, and we have investments that are producing positive cash flow in any type of economy, because as an inside investor and business owner that has financial education, we will always make money in any type of economy. There's no such thing as a bad economy, because when bad economies come, a true financial wise investor will always profit from any type of economy. So a capitalist investor will always make money even in a down economy, because we see opportunities that other people cannot see. We are prepared for the opportunity that does show up, which is better to be prepared for an opportunity that does not show up than it's not to be prepared and the opportunity does show up. So every day counts. Figure out where we are financially. Are we operating on the right side of the cash flow circle today, or on the left side of the cash flow circle? And as we can witness on the cash flow circle diagram displaying on the screen right now, on the left side, the employees have about 40% tax to pay on their income, on their earned income. They have no room to minimize those taxes, and therefore their highest expenses in their lifetime is taxes. And then we have the self-employed, which is taxed at the highest bracket, 60%. We're talking about professionals like attorneys that have their own firm, or a dentist, they have their own small firm. They still have to show up to work. However, a shift on the mindset and the core values about money and the way we view the world anyone can go from the left side of the cash flow circle to the right side of the cash flow circle. Anyone can shift from the poor mindset to the wealthy mindset very rapidly. As long as we apply the information, we have to learn something new every day, apply it in our lives, and then teach somebody else how to do that so that we can improve. As we can learn from the cash flow circle, that those who operate with a poor context are paying the highest in taxes. Basically, all of the people who operate from the left side of the cash flow circle end up paying the most in taxes, even though their bosses and owners of the companies that they work for are paying way less than those working hard for earned income. Mainly it's because the United States is built as a capitalist nation which favors the business owner and inside investor, making legally for us to take advantage of the tax advantages provided in the tax code and laws. The four types of people that exist in the cash flow circle in the world that we live in. Number one, employee is represented by E on the left side of the cash flow circle, or we can say the CFC. A worker or an employee prioritizes a steady paycheck, benefits, and job security. He or she sells his or her time to an employer in order to achieve this. He or she neither understands how money works nor enjoys taking risk. He or she has a conventional education that equips him or her to be a good worker. Now, there's nothing wrong with being an employee if that's what the person truly wants to do for their life. That's their passion. That's what they were born to be. Some people have to stay as an employee. However, I am a believer that everyone has some sort of entrepreneurship spirit in them, and we can always bring that spirit out and mold it to be a master investor. So if you're passionate about a certain topic, maybe there's a product that we can find that we can build from scratch. Even though you're an employee, you can continue to do that. However, learning how to invest and build a business is not a bad idea, because at some point maybe the employee doesn't want to work any longer and wants to retire wealthy, not just barely making it, like many people do with their retirement plan. By the time they retire, there's no money left in the retirement plan, and they have no time left to do anything else, and they struggle financially their rest of their natural life, and it's a tragedy. We want to be in control of money. We want to make money our slave, not the other way around. Self-employed, represented by the S, which is also on the left side of the cash flow circle. And S prioritizes autonomy. He or she works for himself or herself and has no employer. He or she has no employment or owns their own job, basically. Instead, he or she is the employment. And S, or self-employed, issue is that he or she is unable to take time off, just like the employee. He or she ceases to earn money if he or she does not actively work, basically be an employee of their own job. Then we have the business owner, is represented by the letter B. A major business owner lacks both employment and ownership. Rather, we possess a system of systems doing the selling and telling for us, with products solving a problem in the world. The sales are done on autopilot from our systems that we control. It's all about control, not necessarily ownership when it comes to building wealth. Control is more important than ownership, because as we learn, a master investor, the wealthier we become, that means that we're using more debt. We're getting into more debt. So a lot of the things that we will control, they're not going to be necessarily ours. However, we are going to control the asset, the operation, the debt, and we get the passive income. So who cares about who owns what, as long as we're getting the cash flow from the investment? That's what counts, the control. We want to have control. We want to have a voice on our investments and our decisions when it comes to money and what we are doing with our money and other people's money, debt, or the bank's money, or whatever credit card that we want to use to invest into an asset that will produce passive income for us and will pay for the credit card or the loan service, debt service on its own, and will create passive income even after all expenses are paid. We still collect the money. And that's what good debt is all about. It's about making us wealthy because it's putting money into our pockets. So we can say that good debt goes hand to hand with an asset, and bad debt goes hand to hand with a liability. And we want to also learn how to manage liabilities, because as we grow our wealth and our assets column grow, we're going to want to have luxury items and have things that only take money away from us. And we need to understand how to make sure that we are creating an asset and accumulating assets so that they can pay for all the liabilities that we will ever have on our liabilities column. And any expense that we acquire is going to be paid from the cash flow of our investments rather than us working hard at a job to pay for our expenses, which is a very big difference. We want to use other people's money. We want to use assets in our investments to pay for our lifestyle, because that means that it's ultimately free, because we have recycled the money, we have recouped the initial capital back from our investments, we continue to control our assets, and it's cash flow of each asset. We continue to receive that. So it's money for nothing, it's money from thin air. And we can continue to move the cash flow from an asset to a new cash flowing asset in a different asset class, which is key in order to protect ourselves from down economies and hedge from inflation, is by diversifying among the 5 different asset classes that exist today. The 5 asset classes are: number 1, business; number 2, real estate; number 3, crypto; number 4, paper assets; number 5, commodities. As a business owner, we have financial independence because we can quit working and continue to receive the passive income from our businesses and investments. Our attitude is, how can we employ others to generate money for us in the system we have created? Inside investor is represented by the letter I on the right side of the cash flow circle. An investor holds the opinion that wealth may be invested to generate additional wealth. We are skilled at generating passive income through asset investments by utilizing debt, taxes, insurance, and other legal means to create passive income and sometimes capital gains income. We must view the globe as one of plenty and opportunity. We must master using good debt to invest in real assets that we control with our companies. Investment risk on both sides of the cash flow circle. The CFC is clearly split in 2 halves. Employee and self-employed are on the left side, and B, or business owner, and inside investor are on the right side. People on the left side often lack knowledge about finance, entrepreneurship, and investing, and they are afraid of taking chances. However, it is their lack of knowledge that makes investing and entrepreneurship appear dangerous. People on the right side view the world differently and understand how money and investments operate. We think that owning a large company or making investments is less dangerous than being an employee or self-employed, since we lack 3 things: control, knowledge, and training. Since it's self-employed, lacks those 3 things: control, knowledge, and training. Majority of people in the world will always spend their entire life on the CFC left side of the cash flow circle. They often focus on making earned income as their priority type of income, and the only one type of income that they have. When we understand there are 3 types of income: earned income, capital gains income, and passive income. Majority of people focus on earned income because that's what they've been taught to focus on since they were babies, due to the fact that the school system is created to create 2 types of people: employees and soldiers, to be a slave of money, to work for money. So we need to rewire our brains, and everything that we have been taught about money needs to be updated. And we need to be flexible. And it's okay to let go of things that we have been taught that no longer work in today's age. Earned income or ordinary income is taxed at the highest bracket and must be made by exchanging time for money, actively working for money. And the person that works all day for money has no time literally to make money, at least not real, true wealth. As a business and inside investor, we must master how not to work for earned income. Rather, we need to focus on working for passive income. This requires higher level of financial intelligence. We must make investing our priority to make this a reality. We must learn to spend money correctly and wisely and fast. We need to be spending money all the time. It's not about not spending money. When it comes to building wealth, we need to become masters at raising capital from the banks, using credit cards, from OPM, other people's money. Also, at times we would use our capital and we'll continue to move that capital and other people's capital into sound investments. We need to be master at raising capital, multiply money in sound investments in order to build true wealth. Throughout life, majority of people endure many difficulties and frequently express dissatisfaction with their financial situations. Similarly to the game of Monopoly, Master Investor teaches the concepts of building true wealth by using real estate properties, using real assets to get bigger real assets, more assets that produce cash flow, using leverage and increase our wealth annually in our bottom line, our cash flow. What is our positive cash flow that we're making today, every single day? How much are we making from our investments? Because we thrive from that passive income. So we need to improve the bottom line of our investments. We need to always take a look at the cash flow of each investment, of each freedom unit that we work on or we acquire, we build. Redefining the meaning of risk. When it comes to stock investment, we provide the following two guidelines. Number one, don't invest in a firm unless we comprehend how it generates revenue, or a company. We need to understand everything about the company and what they're doing, what's the product. We need to read their financial statements, everything about the company. We must learn and do our own due diligence. Number two, and most likely is if it seems too wonderful to be true. As we have learned, while not investment is ever completely guaranteed to be safe, loss-free, there are things we can do to lower our risk and improve our odds of success. Number one, educate ourselves financially every single day. Number two, by actively investing a small portion of our money, we may get hands-on experience as we begin. Three, comprehend the investment and its returns. Number four, take charge of our investments. Be our own financial advisor. Everyone errs in their investing decisions at times, and most individuals are preoccupied with other matters and don't want to deal with complex finance and figures. It is far more convenient to give someone else our money to invest for us to join in our business's 401k. For majority of people, that's the case. As an inside investor and business owner, we avoid giving our money away to anybody because we take control over our financial future, and we want to have a voice in our investments. We want to control our assets. We want to utilize our money to raise capital, to raise a loan, so that we can invest using financing, using other people's money, so that we can minimize taxes, because debt is tax-free due to the fact that money is created with debt. So the law basically states, generally speaking, debt is tax-free. And when we utilize that money to invest for passive income, the law states, generally speaking, that passive income can be also brought down to pay zero in taxes legally. We can create income with taxes, passive income, even more cash flow, because the government becomes our partners, because we're utilizing the laws and the tax code, we're following the law. And because we're doing that, we can take advantage of the tax advantages that are created to benefit the business owner and inside investor. Investment risk number one, insufficient training. See our piece on the three types of education: academic, professional, and financial. Those are the three types of education that exist. The majority of individuals receive academic and professional instruction or education in school to learn how to work for others or for themselves. School teaches us practical skills like reading, writing, and mathematics that are beneficial in the workforce. It instills in us the employee mentality of following orders from our bosses and being where we are instructed to be at the appropriate time. Some individuals pursue further education and prepare for well-paying careers such as medicine, law, or accounting. However, in the end, they are either self-employed or well-compensated workers. Only a small number of individuals who concentrate on professional academic education are able to transition from the left side of the cash flow circle to the right side. However, we must shift the mindset if we truly want to go from the left side to the right side. The mindset must be shifted, because a person who operates with a poor context cannot live, cannot operate successfully on the right side of the cash flow circle. Regrettably, schools do not teach students how money works or how to make it work for them. It doesn't provide us with the skills required to be an investor or a business owner. Starting with the four fundamentals of financial literacy, we must actively seek out and educate ourselves on those abilities. As a result, the majority of individuals do not have the necessary training to understand how to reduce investment risk. Additionally, investing is dangerous without training, without a plan and expertise, and also a team. Without a team, without the appropriate team, with the right team, without the right team is not going anywhere. Fortunately, Master Investor is here to help us improve our financial knowledge through our coaching classes, games, and books, but not limited. Investment risk number two, lack of control. As they saw their stock portfolios plummet during the last Great Recession, it was probable that many began to think that investing was risky. And once more, it is probable that a large number of people were killed during the worldwide coronavirus pandemic. The truth is that the majority of individuals lack a genuine investment strategy. Rather, they put in a lot of effort and give their money to an expert, which are not an expert because they're just salespeople. They're not an investment expert if they're not making money through passive income. If they live through commissions, then that's what they are. Salespeople who invests in bonds, stocks, and mutual funds. The issue is that these kinds of investments raise the risk of losing money. We have no authority when we invest and give our money away to somebody else to do it for us. We are entirely dependent on the markets and managers that controls those funds. That puts us in a risky situation. In contrast, successful investors aim for as much control as we can get to lower investment risk. Indeed, we have written an article discussing the 10 essential investor controls that savvy investors must possess in order to succeed. That is why real estate is a good investment choice, because it may lock in cash flow for long periods of time. And it is also why we should put money into companies where we have the ability to make decisions. In either scenario, the investor has significant influence over the fate of the investment. Investment risk number three, lack of understanding. Most of us instinctively understand that being inside is necessary if we want a real deal. It is common to hear someone say, I have a friend in the business. The type of company is unimportant. It might be for a new dress, tickets to a play, or a car. Everyone understands that agreements are reached on the inside. The same is true for the investment world. If we are not in the inside, we are outside. Generally, workers and self employed individuals make investments from outside, where there is a high level of risk involved. Their understanding of what they are truly investing is quite restricted. Individuals who work as professional investors and business owners have a thorough understanding of the inner workings of our investments or enterprises because we have the insider information that considerably reduces the risk of our investment and are the ones driving the business or investment. What seems safe could actually be quite dangerous. Is it safe or dangerous? When it comes to investing, those terms must be redefined. Here are three places that conventional financial advice has recommended as safe for us to invest our money. Are these investments safe or dangerous? Number one, mutual funds. Number two, 401ks. Number three, savings. The average financial planner will assure us that they are secure. Why will successful investors say otherwise? Savings. Our money is worth less and will purchase as less in the future as a result of the declining value of the dollar and other worldwide currencies. Today, the US dollar is a full currency. It's not longer real money because in 1971, August 15, President Nixon separated the gold standard from the US dollar. From that point forward, money became monopoly money, fiat money, fake money, and just an idea backed up by confidence. Additionally, the fees and costs associated with maintaining the money in the bank may be higher than the interest we earn from the bank on our savings. In many instances, we might be losing money by saving it. Would we categorize that as high risk or low risk investments? An asset is an investment that repeatedly loses money. An asset is an investment that repeatedly makes money in any type of economy. And a liability is an investment that repeatedly loses money over and over again. And that is a bad investment. So we need to focus on the difference between an asset and a liability, which we can tell by the way the cash flow is flowing. So an asset is putting money into our pocket, and a liability takes money away from our pocket. 401k plans and mutual funds are fake assets. A mutual fund is just a bundle of other similar investments such as bonds and stocks, a firm that aggregates the funds raised from numerous investors and then invests them in stocks, bonds, and other comparable paper assets could also be involved. A 401k is an employer-sponsored retirement plan typically viewed as a retirement savings plan that permits workers to deposit a percentage of their pay into it. The employee's contributions to a 401k plan are invested in mutual funds. Similar plans are available in other nations under different names, such as the United Kingdom's pension scheme, Japan's 401k, Canada's RRSP, and Australia's and New Zealand's superannuation plan. What is the reality of mutual funds? It is fantastic indeed for an individual who is now 20 years old and beginning to save for retirement. Let us provide all of us with a long-term example that we discussed in other talks, that an individual has roughly 45 years until retirement, 20 years until they turn 65, and then according to the actual tables, another 20 years unto death finally ends their life. That amounts to 65 years of investment with an 8% return on a $1,000 investment made at the start of the period. The total will approximately be $140,000 after 65 years. In this case, the mutual fund system will deduct around 2.5% points in fees from that return, leaving the persons with a gross return of 8% and net return of 5.5% instead of over the course of 65 years. The 1,000 will grow to roughly 30,000, with 110,000 going to the financial system and 30,000 going to the person, the uneducated investor, saver, or passive investor, and employee or self-employed. Mutual funds and other toxic investment vehicles are liabilities because they take money out of the pocket of the individual instead of making money for the uneducated investor. Give that some thought. This implies that the financial system receives about 80% of the return while contributing nothing in capital, taking no risk, and incurring no cost. Furthermore, the saver, the uneducated investor in this long-term investment, which lasts a lifetime, provided all of the money, assume all of the risk, and receive just around 20% of the return. If that, due to this cost, some of which are hidden and some of which are visible, associated with financial advice and brokerage, uneducated and saver investors are being failed by a financial system that is failing them today. Therefore, the system must be repaired. The mutual fund firms, the salespeople, and the managers all profit regardless of the financial success of their clients or their investors. The majority of people are unconcerned with the fund's real performance. Their primary concern is with their fees and commissions. Is that safe or dangerous? How can we reduce the risk of our investments? No investments is without risk in the world of finance. We will both gain and lose money when we invest. That is a sure thing. However, there are definitely ways to increase safety and decrease risk. And of course, increase the speed in which we receive our return on investment. The more financial education we have, the better return we will have and achieve in every investment that we will ever embark on. Actively striving to shift our mentality from the left side of the cash flow circle to the right side of the cash flow circle is the first step in reducing investment risk. However, investing on the left side is much more difficult because there are numerous opposing factors, primarily a lack of control, even with experience and expertise. This is not to say that they cannot invest on the left side. Furthermore, individuals on the left side sell their time for earned income, which means they seldom have the same amount of time to handle their investments as those on the right side of the cash flow circle. Gaining the appropriate training and knowledge and applying it so that we may be in a position of authority is what moving to the right side of the cash flow circle entails. This implies that we should regularly improve our financial knowledge through seminars and coaching. We must, however, put that knowledge to use in the end. Nothing teaches us more than experience, failure, and perseverance. It takes financial knowledge and experience to transition from a risky investment posture to a secure one. Evaluate our investment stance honestly and take the actions required to gain knowledge, control, and training. It will be one of the most intelligent choices we will ever make. Why investing with the cash flow tetrahedron formula is key. When we invest and plan our plan to becoming wealthy, by using the following proven formula to invest in, like the ultra wealthy invest. We focus on becoming truly financial knowledgeable so that we can solve financial problems with lucrative solutions. By investing using the formula of the cash flow tetrahedron, or the CFT, is key to achieve ultimate wealth and rise to the highest level of an investor, level 5, or a capitalist investor. Using the CFT to structure our investment strategy, as we can see the diagram on our screen, we can create money from thin air legally and obtain our assets and liabilities for free legally, because we have mastered raising capital and making passive income with that capital we raised from investments. Focus on building and acquiring businesses that produce positive cash flow and using that cash flow to fund other sound investments in different asset classes such as real estate, crypto, paper assets, and commodities. Our positive cash flow from our business will begin to pay all of our expenses and other investments as well, which means that since we are using OPM or other people's money, debt, loans, cash flow from our businesses, etc., to expend such positive cash flow, even more constantly diversifying among the 5 asset classes to protect ourselves from down economies and hedge for inflation. There's no such thing as having a bad economy. The economy goes down and up, and we make money in any type of economy because we have prepared for any type of economy. We have real assets that we control with our companies producing positive cash flow, even when the economy crashes. And in fact, when the economy crashes, we can capitalize on even more opportunities for a bargain because everybody else is panicking and no one else was prepared like we were or like we are today. So the cash flow tetrahedron shows us how we are supposed to build a business that produce positive cash flow, and we use that cash flow to pay for our living expenses and fund any other asset in different asset classes as we expand our wealth and increase our bottom line, our positive cash flow, or our passive income. Bonus, what is the secret to getting wealthy? Always paying ourselves first and making investing our number 1 priority on our expense column on our personal financial statement is the secret to getting wealthy. Number 1, quit saving our money if we want to get wealthy. Number 2, don't let bad debts prevent us from getting wealthy. Number 3, the 10-10-10 rule, a guaranteed way to get wealthy. Who does an employee and self-employee pays first when either one gets a salary? Like the majority of Americans, they are likely prioritizing rent, mortgage, food, electricity, car payments, insurance, government, and other expenses. Majority don't even have investing as an expense. Then after the employee and self-employee or the poor context people have settled all of those expenses, then they put whatever is left, if they have any, into savings. This is a typical example of paying oneself last. The poor mindset then patiently waits for the next salary or paycheck. The poor context person then goes through the entire procedure again that makes them poor. That is the big American rat race. However, if anyone ever wants to escape the rat race, then the person must acquire the wealthy context and shift the values about money internally. It takes financial education, financial experience, and excess of positive cash flow to succeed in investing. Rather than saving, the wealthy do this, the 10-10-10 plan. The 10-10 strategy to create more wealth each month. An employee and self-employed can split 30% of their paychecks as follows. 10% investment. They save 10% of their monthly income for amazing investment chances. They usually decide to put their money into real estate. Number 10, next, 10% for financial education and special moments. then the person should allocate 10% of the monthly earned income for emergencies and unique occasions. This was not a savings account meant for sustenance. This is to increase the purchasing power of the person. 10% charity or tithing, and since they have faith in giving back and that we must give in order to receive, a person should proactive become more generous, as it is how we become wealthier. Being generous is the key to become wealthy beyond our dreams. Every business is created to solve a problem in the world. So we have to be generous to solve other people's problems, as we have to think of others too and give them what they are in need of. The person should dedicate 10% of their monthly earned income to tie-in or charitable contributions of their choices. Don't save money if you want to get wealthy. That's the message of today's talk. Saving money is a popular piece of poor context mindset financial advice. Saving money does not lead to wealth accumulation or maintenance of that money, neither. Saving is a surefire way to fail in business. Start investing in high quality financial education by reading our financial ebooks. What are the 10 new rules of money? That's one of our ebooks that we have available right now with a digital course. Go on our website. We also have how to build cash flow with the internet, turn passive income on. And we have how to invest in crypto to build wealth, understanding Bitcoin and blockchain, the rise of legitimate reserve digital currencies and assets. We have additional resources and tools. Find us on Instagram. We also have a podcast. Subscribe to our newsletter. Subscribe here on our YouTube channel. Follow us on TikTok. Purchase a business digital course here with us at Master Investor. Like our Facebook page. Join our Discord. And make sure to join us on our mission here at Master Investor, which is to be the global authentic brand of money, business, and investing that elevates the financial well-being of humanity through high-quality financial education made simple. We look at opportunities to build passive income, win-win partnerships, and true wealth. Today, we discuss how to do risk management and investing. Let me know exactly what questions we have after today's talk, and I'm going to come back and answer any questions that anyone has. Make sure to go to our website, get our ebooks, subscribe to our newsletter, and start investing in financial education, create a business plan, figure out what type of problem we want to bring into the world, and let's get to work on building our assets column. Let's work to build passive income. And make sure to let me know in the comment section below what we learned today, what inspired you about today's talk, and what is the one thing that we are going to be using that we learned from today's article on how to do risk management and investing. What piece of tool or mindset we're going to use to make sure that we lower our risk, or to control and calculate our risk when it comes to investing, and how to invest like the ultra wealthy. I hope that we learned a lot today. Thank you for having me on another amazing talk on money, business, and investing. My name is Jose. Make sure to find us on our website, get our digital courses. Invest in financial education is the best type of education that we can have. Bring you the good and bad news of money, the business principles that work in all economies. Thank you for your business. I'll see you on the next video. Stay extraordinary and wealthy. Bye for now.